Hi friends, in present video I am going to explain about the disadvantages of index funds. As every coin has two sides, investing in index funds also has its own limitations. Let us see the first limitation. Higher tracking error. For example, one asset management company launched an index fund scheme which is tracking market index Nifty 50. Now the main aim of fund manager is to match the returns of index fund with that of market index. It doesn't mean that both returns will be exactly the same. Slight difference is common, which is known as tracking error. For example, index fund returns are 11% and the market index returns are 12%. Here the difference minus 1%, a lower tracking error, is common in case of index funds. But assume that the returns from index fund are 4%, resulting a higher tracking error of 8%. A higher tracking error indicates the inefficiency of fund manager and the poor performance of index fund. So the higher the tracking error, the more manager is deviating from benchmark. It indicates that something is going wrong. No investor prefers an index fund with higher tracking error. So eventually a higher tracking error due to the inefficiency of a fund manager can be a disadvantage of index fund. Second disadvantage is limited gains. In developing countries like India, the returns from index funds are less than the returns generated in actively managed funds. There are four reasons for this. First reason is expensive. In case of actively managed funds, when market is high, in other words, during bullish market, fund manager can wait till the prices come down. But come to index funds, in India, majority index funds primarily focus on frontline market indexes like Nifty 50, Nifty 100, Sensex, etc. So these market indexes portfolio contains the stocks of well-established companies. So naturally, the stocks are expensive. Assume that at this stage, stock exchange made some changes in the composition of this portfolio. They replaced one underperforming company, A Limited, with profitable companies, B Limited and C Limited. Now, the fund manager has to incorporate the same changes in fund portfolio. Even though market is high, even though these stocks are expensive, fund manager has to purchase them. Thus, fund becomes expensive. By paying higher NAVs only, one investor can acquire index fund units. So, in future, even though market conditions are favorable, investor cannot expect much increase in NAV because already it reached to a maximum limit. Thus, expensive stocks of fund portfolio do not allow the fund investor to gain more. Second point is no flexibility to the fund manager. For example, one index fund is tracking Nifty 50. Fund manager is bound to invest in the stocks of all these 50 companies. Some of these companies may do well, others may not. However, he still has to stay invested in such companies even if they hurt the portfolio. On the other hand, fund manager cannot invest in the stocks of growth potential companies because they are not the part of market index. Thus, the lack of flexibility to the fund manager may limit the returns of index funds. Third reason for limited gains is no alpha generation. Take one actively managed fund. The main aim of fund manager is to generate alpha. Alpha means the excess of fund returns over market index returns is known as alpha. For example, one actively managed fund has generated 18% returns and market index returns are 8%. Now 10% is known as alpha. Thus, in case of actively managed fund, the fund manager always tries to beat the benchmark. But in case of index fund, the main aim of fund manager is not to generate alpha. He tries to track the market index. In other words, he tries to match the returns of index fund with that of market index. Warren Buffett, who is widely considered as one of the most successful investors in the world, recommends index funds. So for developed countries, index funds are recommended because in those countries so many companies are already developed and there is so much of competition among asset management companies. So for one actively managed fund, it is almost impossible to beat the benchmark index. It is useless to invest in actively managed fund by paying higher expense ratio. It is better to invest in index fund because at least they can get market index returns. Moreover, the index of developed countries contains more number of companies. Thus, investor can get more diversification benefit. Come to developing countries, India. In our country, there are many small cap and mid cap companies which are in developing stage. So if you invest in those companies by purchasing one actively managed fund, then easily you can beat the market index. In our country, actively managed funds are able to generate alpha. Moreover, if you see Nifty index, it contains only 50 companies. If you take Sensex, it contains only 30 companies. Thus, Indian market index gives less diversification benefit to the investor. And remember one point, if you want to invest in any actively managed fund, then it is recommended to go for multi-cap fund because this fund gives diversification benefit. Fund manager can switch between the large cap, mid cap and small cap stocks as per the market trends and he can generate more returns for the fund. If you want to know more about multi-cap funds, you can see my video on this topic. Link is available in the description box and in icon. Last point is dedication to reduce tracking error. For example, stock exchange has decided to make some changes in the portfolio of market index by adding 2 profitable companies and by removing one underperforming company. Then stock exchange informs to all investors well in advance to give ample time to the investors to buy and sell the same stocks. In case of actively managed funds, the fund manager purchases those profitable companies and sells those underperforming companies well in advance, that is weeks or months before, to generate profits for his fund. Assume that market index is going to change the portfolio on 5th July 2019 and the actively managed fund manager made changes in his portfolio on 1st June 2019. But an index fund manager cannot buy or sell the stocks preemptively because he has to take care of tracking error. For example, he sold that underperforming company stocks on 5th June 2019 and he purchased profitable company stocks on 15th June 19. If reconciliation is done on 30 June 19, on that day definitely the returns of index funds differ with the returns of market index, which leads to a higher tracking error. Therefore, he doesn't sell that underperforming stocks till the last second of this change. Similarly, he doesn't purchase the profitable company stocks till the market index officially adds them in the portfolio. Due to this delay in purchasing and selling of stocks, index fund loses some profits. Research shows that due to this reason, dedication to reduce tracking error, there is a loss in index fund between 0.2% to 0.77% a year. So this is all about the disadvantages of index funds. Hope this video is informative. Thank you.